Hello everybody, Captain here, and this vacation was not relaxing. This is my last day of vacation. I'm going to go home. I'm going to do nothing. I promised myself I'd take a day vacation where I wouldn't do anything. And then I just go and do it. Anyway, we're finally going to catch up on these video requests, and this, the doc, we're just going to call him the doc. It's a different doc, not the one that you may have heard of. This is a different doc. And this guy's been waiting very patiently, so I apologize to the doc. Hello, given the current rate of inflation, is it worth keeping money in a checking or savings account, or will the accumulated interest be inadequate to offset the depreciation caused by inflation? And then he has a second question, so I'll answer that one first. For the most part, no, it is not adequate enough as it is right now. Your inflation rate, of course, it depends on where you live, because it's very geographical, running at like 2.5%. And then your interest rates are like 1%, sometimes 0.5%. And without going into too long of a boring story, banks in the olden days, they were created as basically large safes. People had their money, they didn't want it to be robbed by bandits or thieves, and what they would do is they go to typically a goldsmith, somebody who had to protect. They had valuables themselves. They have a safe or a bank, and so you could see how it's slowly through the evolutionary process of financial services, you go from a goldsmith to an actual bank with a vault. Now, the primary purpose was storage. It was not investment. That never had anything to do with it. So you would actually pay the bank a percentage to keep your gold in the lion's share of your wealth protected. Right? Now, as time went on, and you have lending and fractional loan reserve lending, it was more like the banks were like, well, we got all this money here. It's sitting stagnant. Well, if we find someone who's lending money, or who wants to borrow the money, we could lend it to them. You know, companies, individuals, prospectors, whatever. So they lend it out, and then, this is not how it happened, but mentally this is what happened. The people whose money was being lent out say, hey, whoa, Jim, bada boom, bada bing, what are you doing lending out our money? And the bank would say, all right, we'll give you a percentage of the interest. So we'll charge Fred 5%, and we're going to pay out Billy, who lent us Bill's money that we lent to Fred, 2%, and we'll net 3%. So that's how that jump made. So, but beforehand, you actually had to pay. Now, what's happening is on this end, Fred's end, there's not a lot of demand for money because the economies are stagnant. I know whatever you hear, look at interest rates. Interest rates are very low because no one demands the money, so there's no demand for the money, so the interest rates are very low. And these people are, the banks are now, you know, you get your deposit, make your deposit, like, well, no one's clamoring for our money, so we got to lower our interest to be effective and competitive. So we can't pay out that much interest, and they don't, and it's not even enough to cover inflation. Now, what's worse is throw in a central bank, like the Federal Reserve, which is basically propping up the entire banking system. Well, where can banks get money? Well, they can borrow from the Federal Reserve. So the Federal Reserve has a fucking what? 0.00001% interest rates? Hell, they're negative out in the European Central Bank area. So they don't have to go to the people and say, hey, you deposit money with us and we'll pay you a 1%, 2%, 3% interest rate. They're like, fuck that, we can go to the Federal Reserve and we can get it at 0.5%. And then we can lend out to Fred at 3%. So that's why your interest rates are so low on your savings and your checkings accounts. So no, it will erode against inflation, and then that behooves the question, like, okay, where do you put your money to hedge against inflation? Over the long term, and I know I'm leaving a lot on the ground, don't come in here, well, technically housing hasn't outpaced inflation. You would invest in other assets that would appreciate in value. So you would invest in the stock market, you would invest in housing, you would invest in something, businesses, ETFs, mutual funds, whatever. The problem there, though, as you're fully aware, is that those prices don't go up consistently. You have a stock market crash, you have a housing bubble crash, you have a dot-com crash, and they go like this. Not to mention, you're taking very liquid assets, which is cash. Like you can cash it in, well, it is cash. It can't be any more liquid. Liquid means how close to cash is it. You know, savings is very close to cash. Stocks, very close to cash. You can cash those out in a day, get your cash. But housing and real estate, not so liquid. You know, you gotta find someone to buy your house. That takes a while. It's not like you're just going to the bank and cashing in some bonds. So there's only really one investment that beats inflation, and that is inflationary adjusted bonds. And once again, you run into that the maturity issue, the liquidity issue. Bonds are typically more liquid, so you can liquidate them in the market and get your money's worth. But inflationary adjusted bonds basically pay you inflation plus a certain percentage above that. 0.5%, 1%, 2%, depends. And so you can find them. Talk to your broker, get those. But again, it's not like having a checking account or a savings account. Checking account and savings account, that really is a service the bank is doing for you because they're providing you convenience to purchase. I'm not a big fan of banks. Don't worry. Don't you me worry. I hate them. But that is a service. They are providing you a convenience, like checking transactions and credit card services. I imagine how much it paid. It's a lot of hell. I got pissed. Me and my buddy, we didn't get pissed, but we were inconvenienced. We were going to go to the casino over in Tampa, and he's like, I don't have cash. I said, I don't have cash either. I just got my credit card. I want to go to the ATM. I said, well, I don't have a bank down here. And then the other banks have used the other bank's ATM. They don't like that. Then they charge it. And then they spread your ass cheeks and they take a $5 surcharge out of your ass. And then he's like, well, I don't know if I want to go to the ATM. I don't really want to go to the ATM either. I'm like, we probably lose the money. Yeah, we probably will lose the money. And so then we just went and had cigars instead. But again, it is a convenience that bank. Imagine if you had your bank, you could get the cash. You can write a check. The online payment services. This is all a service that, and one of the few good ones that banks do provide. So there's that. Now the second question. Additionally, I appreciate if you can comment on whether certain bank accounts, college funds, trust funds, are tax or tax deductible, and whether how that factors into the above. Well, bank accounts. You can. Here's what you want. You want what's called a 529 program. A 529 program is a college fund. It's like a 401k. You contribute money into it, and it's tax deductible. Oh no, wait, hang on. 529. No, you put it into the fund, and the withdrawals. You know what? Let me give you precise information. I should know this because I taught this, but there's so many freaking plans. You kind of lose the. You lose the. Well, was it this plan? Was it Coke plan? Was it that plan? Wikipedia. Just want to be accurate. No, I don't want to donate to you, Wikipedia. You and your leftist slanting hippies who write. Tax advantage overuse advantages. I'm bored. It's not used. Oh, come on. Let's go up here. I just want to know if it's tax deductible. Prepaid plans. No, we're not talking about them. Gain the qualified distributions. Okay, yeah, it is the distributions, not the contributions. All right, I want to make sure. So basically, 529 plan is you throw money into this fund. This fund then invests in mutual funds like a 401k does, or whatever other investable assets there is. And then there's a beneficiary that you designate. So typically it's the parents throwing money into the 529 plan, designating a beneficiary as their child or children, depending on how many they have. And each plan has each child. That child then goes to college. They withdraw the money from the 529 plan, but they do not pay taxes on that withdrawals as long as those withdrawals go to pay for expenses that are related to education. You can look it up and find out specifically what that is, what those are. But tuition, lodging, stuff like that. So it's not like you have banks. Banks do not. It's like the law that allows you to do this. Some banks will have a 529 plan. Most won't. You have to go to a brokerage typically to set it up, and they'll say, oh yeah, they'll say, oh yeah, we got an IRA account, we got a 401k account, well, 401k through your employer. IRA, simple IRA, stuff like that, and it should have a 529 plan. Sometimes the bank has this, sometimes you gotta find a broker, so talk to your bank. And then you look at, here's the next step, before you go, oh, 529 plan, here's my money. Look to see what assets they have available to invest in. Because a lot of these banks, a lot of these brokerages, you should be able to invest in anything. Frankly, anything you can online through the financial markets. Anything. Stocks, mutual funds, REITs, whatever. But a lot of these banks and a lot of these financial institutions will have an allegiance with Vanguard or Fidelity or some other mutual fund company, and they'll only allow you to trade in those mutual funds because these cocksuckers over here bought off these cocksuckers over here. So you want to find a place where it's like, no, we allow you to invest in whatever you want. Now, should you invest in? I can't tell you that. That's specific financial advice. But that's how it would work. Now trust funds are a completely different thing. You being a doctor, you probably might want to look into that. But a trust fund is basically a separate legal entity that has a beneficiary designated and has a trustee, manager that manages it. So what you do is you set up this legal trust, this legal separate entity. You put money into the trust. It's not your money anymore, it's the trust money. And then you can still manage it, but it's not your money because it's the trust money. And then the beneficiary, depending on when you want to pay out this money, could be your child, could be another corporation that you own, it could be a friend, it could be your wife, it all depends. And that's why trusts are so useful for asset protection, is because look, the doctors use this all the time, and probably, certainly you being a physician should look into it. Because, you know, you get sued, and they come after you, the doc. Well, a lot of doctors put all their assets name in their wife's name, or they put it in a trust. But while it's somewhat functionally similar to a 529 plan, it's for a completely different purpose. It's asset protection, not to pay for your college. So if you have kids, that's why you're inquiring. Yeah, set up a 529 plan for them. That's the way to do it. But then when it comes to trusts, that would be more protecting your personal assets, and you definitely want to talk to a lawyer that specializes in trusts, or ask around some of your doctor colleagues and see what they recommend. And then trust can be taxed. Let me do this first. The 529 plan. If all of a sudden you have more money in the 529 plan than what the kid needs for tuition, you can redesignate a new beneficiary. But if you don't know anyone you want to give the money to that has college expenses, then you're going to have to pay a 10% fee on the final withdrawal of all that money because it's not going towards educational expenses. So that's where you do pay tax on that. When it comes to trust, depends on how it's set up, but if you repatriate money to yourself, that's income for yourself, you do pay taxes on that income. If it goes to some other corporation overseas, whatever schematic you have set up, there's a way to avoid paying taxes legally as well. But that's way above my pay grade, and I only know the certain basics of it. So anyway, hope that helped. Apologize for the delay, and thank you very much for your patience. Toodles.